welcome to Better Investing Ticker Talk. It is wonderful to see all of you here this evening. We are in for a great show, and let me get to our panelists very quickly. We do have a first timer joining us at Ticker Talk this evening. Ionnie McNeill, you see there, is a director with the NAIC Better Investing Board of Directors. She may have the status, I'm not sure, Ionnie, but you may have the status of, at the time, being the youngest lifetime member, because she
Oh,
became a
wow.
lifetime member at 12 years old. I mean, I don't know that for a fact, but that just seems like you might have been. Uh, she's also, in addition to what her volunteering with the Better Investing Board of Directors, she serves as the president of the Better Investing South Florida chapter, and also the president of their model investment club there. And she has written a book called The Baby Billionaire's Guide to Investing. And it explains the importance of early investing early, and the power of compound interest. So, welcome, Ionnie. It's wonderful to have you here.
Thank you, Anne.
And we have also Ken Kavula. Maybe you weren't the youngest lifetime member, Ken, but maybe you were. I don't know, but
No. I might be the oldest remaining member. I don't know.
No, not even close. Not even close, Ken. And very young at heart, but he's a regular, always helping me out here at Ticker Talk, retired educator, excellent instructor with Better Investing, director with the Mid-Michigan chapter. Many people know you, Ken, and love all your teaching. So thank you so much for joining us again.
Oh, well, this is a pleasure, Ann.
All right, and my name is Ann Cuneaz. I am the Senior Manager of Education Programs at Better Investing, rounding out your panel here. So let's get started. Quick disclaimer, guys, I always have to remind you that everything that we're talking about is strictly for educational purposes. We aren't making any recommendations to buy, hold, or sell any securities. We may own some of the securities that might be mentioned. We try to tell you that when that happens, but we aren't really promoting our own stocks. This presentation might contain various websites or mention products that aren't officially endorsed by Better Investing, and just mentioning them in this webinar is not a formal endorsement. As always, we are recording this session, and it will be posted in the video learning library on the Better Investing website. All right, so tonight's program really is all about the stock selection guide, different aspects of the stock selection guide. So we're going to start off with taking a look at PEs and trying to keep PEs in perspective in these kind of crazy market times that we have. And then we're going to segue into looking a little bit on how to choose a low price and get some guidelines there. And then we'll wrap up with taking a look at the visual analysis, the big graph on the SSG, and what reading between the lines can tell us. And as always, we will leave you with a few stock ideas that you can consider in 5 in 5. So with that, we're going to start with the PE section, and I'm going to turn things over to Ionnie. She's going to get us started. So Ionnie, whenever you are ready, you can take it away.
Thank you, Anne. And hello, everyone. Again, my name is Ionnie, and I'm really excited to be invited to this Ticker Talk because of the amalgamation of topics that we're going to be discussing tonight. So I'll kick things off with this first topic of keeping the PE in perspective while experiencing a down market. Currently, we are experiencing a lot of market volatility, and we may even be possibly heading into a bear market. So, with knowing all of that, I want to encourage us all not to get distracted by price fluctuations. Instead, let's use the high and low PE trends that we can observe in the SSG section 3 to be prepared for future volatility. Despite all that's going on in the news, it's not all about the stock price. And especially within the better investing community, we analyze a stock's price in relation to its earnings. Therefore, the real question we should be asking ourselves is, how many times earnings will the market pay for a stock? I'm going to go over two different types of markets just so that we can start to understand economic conditions and further analyze what type of market we've been in and what type of market we may be heading into. Generally, in a bull market, people are overly optimistic. They will generally overpay for $1 worth of earnings, thereby driving PEs up. Investors also during a bull market will forget to look at fundamentals, unfortunately mistaking luck for skill. On the contrary, in a bear market, people tend to be overly conservative. PE values are compressed due to a lack of speculation and volatility. And in general, investors want to minimize their risk for the same amount of reward. In short, investors want more security in a bear market. So this is where the PE ratio comes in. And for anyone that may not know what a PE ratio is, I put the definition here as price divided by earnings per share. In essence, a PE ratio represents the multiple people are willing to pay for $1 worth of earnings. And when I say earnings, I mean earnings per share. Other investors generally have a shorter term memory. And when they're doing research on stocks and even projections into the future, they tend to look solely at the 52-week high and low. But as better investors, we have a longer memory, and we are able to have that longer memory because on a day-to-day basis, when we're analyzing stock, we're looking at 5 to 10 years worth of data. Specifically within Section 3 of the SSG, we have access to the past 5 years of high and low prices, earnings per share, and high and low PEs. And this gives us the advantage of framing current market volatility within the context of this upcoming economic cycle. In essence, this allows us to be realistic and reasonable in our forecast. For a better understanding of current market conditions, I invite you to check out the Ticker Talk hosted in November 2017 entitled Investing in an Overvalued Market. There's a 5-minute segment between minute 15 and minute 20 that, if you don't have a lot of time, I would, bring your attention to that short segment where Cuneaz and Ken Kavula do an amazing job really explaining the major impact that inflation and interest rates have on PEs. So again, I ask the question, in this current market, how many times earnings will the market pay for a stock? The answer to this question requires action. Number one, let's look at the PE ratios historically. Number two, let's recognize the trends that we see in those numbers. Number three, let's keep in mind the overall changing economic conditions. And last but not least, and probably most importantly, Let's use that insight to inform our forward-looking projections. So the first company that we're going to be taking a look at is Alphabet. And here is a snapshot of the Section 3 of the SSG for Alphabet. I want to bring your attention to columns A and B and also columns D and E. See if you can notice any trend, or just ask yourself, does anything pop out at you when you look at these two columns? Well, I should say 4 columns. One thing that I noticed in columns A and B is that the high price of 2017 became the low price of 2020. That's just one observation that I quickly made in looking at the 52-week high and lows for the past 5 years for Alphabet. In columns D and E, what I noticed is that both the high and low PEs are trending downward. So with this analysis, those are things that I would consider factoring in when I make my judgments in section 4. The next company we're taking a look at is Trex. Again, what do you see popping out at you in columns A and B and D and E? For me, what I noticed with Trex in looking at columns A and B is that I could have bought, or you could have bought Trex at $30 anytime between 2017 and 2021. So just, taking a look at the price ranges for the last 5 years, it's kind of always past that $30 mark, except for 2021. In columns D and E, I noticed that in the past 5 years, this stock has traded at a PE as low as 18 and 19. So I brought up these two companies because they are vastly different, and as we just saw, we were able to observe different trends. So I invite you all to do that when you're doing your SSGs, to really just take a look to see what type of picture those numbers in section 3 are really painting for you. I'm presenting on this topic because I want you to find comfort in knowing that you have access to PEs that can prepare you for a downturn or even a bear market. Again, use section 3 of the SSG to do more than just grab the high and low PE average and plug it into section 4. And also use the 5-year PE and price trends to think critically about what's next and prepare for even more future volatility. Market low prices are not created in a vacuum, nor out of thin air. They generally fluctuate within a range, and it's best to look at the PE range to better understand a stock's volatile price range. Currently, the market is valuing profitability over potential. The market wants security and is no longer continuing to pay a higher premium for stocks with little to no earnings. So, in conclusion, with the current market volatility that we're experiencing, rising inflation and interest rates, and possibly even an impending bear market, I encourage us all not to get distracted by price fluctuations, but instead, let's weather the storm with realistic expectations and reasonable projections by keeping the PE in perspective.
All right. Thank you very much, Ionnie. Good advice there that we should all pay attention to in this I was going to use the word crazy, but I'll just call it volatile market these days. All right. Well, I don't see any questions right now, but we are continuing to monitor those. So, Ken, I am going to come over to you and you can piggyback on this topic and talk a little bit about selecting a low price.
What I'm going to speak about this evening is choosing a reasonable low price on the stock selection guide. Choosing a reasonable future low price on your SSG is crucial. It's one of the most important steps that you're going to make, excuse me, on your stock selection guide. And here's a few guidelines that are used to keep my predictions, my judgments, my ideas both realistic and reasonable. You know, it's not a question of how low can you go in setting that low price, but rather it should be a question of how low should you go. A lot of times people pick low prices that, in my opinion, are too close to current prices or are much too far away from current prices to allow the SSG to speak to them in some kind of language that we can understand. If you'll put some thought into the choice you make for low price, then you'll allow your analysis to become more realistic, and at the same time, it will become much more reasonable. There is so much going on in today's market. We've talked already this evening about volatility. The PE values for all of the stocks in the stock market are being reevaluated by the market itself, by the people that buy and sell stocks on a daily basis. And what we're finding is that PE values are being pushed down. That happens in times of rising interest rates. It happens in times of rising inflation. And those are two things that are going on right now in the macro world, which are impacting the stock market that we're trying to invest in. We're also experiencing the change in investor psychology. A year ago, there were many investors that were quite content to take stocks with no earnings, but with a small history of sales and buy them at extremely high PE values, or if they have no earnings, to buy them at no PE value at all. After all, PE is a fraction, price on top, earnings on the bottom. And if you have no earnings, you can't even calculate a PE value. All these things that are happening right now take many of our members and put them into what I call analysis paralysis. They tend to overthink the task at hand. And I find if you break it down into smaller steps, the task becomes manageable. Let's look at a typical Section 3 from a stock. Since I'm looking at Section 3 already, and this stock happens to be Domino's Pizza, ticker DPZ, since I'm already to Section 3, I've gotten past the visual analysis and the management comparisons. I've decided, in my mind at least, that this is a quality growth stock, and I'm on to figuring out affordability for this particular stock. Remember, my goal is to not just buy a high quality growth company, but to buy it at a reasonable price. I'm looking right now at column E because this talk focuses on setting a future low price choice. There's that column blown up even bigger. And my initial reaction on any SSG, whether I'm doing a brand new SSG or whether I'm coming back and updating an SSG that I might have done a year or 2 years ago. The first thing I'll do is I'll look at that average at the bottom of column E, and I'll use it to see what that gives me for a future low price. In this case, the average was 23.5, and the most recent 4 quarters of earnings, that's worst case scenario for a growth company to not earn any more 5 years from now than you've earned in the most recent 4 quarters, would have been $13.05, giving me a forecast low price of $306.70. Well, this is where many people stop their analysis. They accept the value, they fill it into the computer form, and they move on. I'm suggesting that this is a great time for you to do some thinking. After I choose this average value, I look over to the right of the form and I see a little kind of a synopsis box that it says evaluating risk at a glance. I'm looking specifically at the upside downside in this box. And I think what's happening when I view that number is I see the SSG actually speaking to me. In fact, I think it's almost shouting to me. What's it telling me? I think it's telling me that my judgments about PEs going forward might be a little bit too aggressive. That upside downside in double digits is probably telling me that I should re-examine my justification for the PEs that I've chosen, especially in this case at the low side. Well, when this happens, when I see this double digit upside downside, I immediately go back and try to rethink my low PE value. When I look at these PE values, I notice that they're clustered quite tightly, and that's what I like to see in any stock that I'm considering for purchase. I like to see relatively consistent PE values, both at the high end and at the low end. But I do notice that the highest of this relatively tight group happens to also be the oldest piece of information. What happens if I strike it and look at the average from just the last 4 years? Well, that takes the average down to 22.7. Considering that the market is in the process of resetting all of the PEs going forward, I'm going to round that value down to 22, and I'm going to see what happens. Remember, folks, that what I'm trying to do is come up with the answer to a question, and the question is, what will the average low PE be 5 years from now? I'll actually know if I'm correct if I don't change that value during the next 5 years. And when that time rolls around, I'll see how close I actually came. But I'm realistic enough to know that the SSG is a dynamic process. And between now and 5 years from now, different things might change my opinion of what the average might be going forward. Let's try that 22 and see what happens. Well, when I fill in 22, that changes. And again, I'm just glancing to the right on the form, the computer form, and notice the upside downside has moved back into a territory where it's not shouting. I still think it's a little bit high, however, and I'm going to do a little tiny bit of simple arithmetic. My low price of $287.10 is about 17% below the current price. Let's examine some other choices that I might make because I'm a little bit antsy about picking a low price that gets too close to the current price. Now, there are lots of rules of thumb out there, and those rules should have some dynamism in them, which means that there are times for you to pick numbers that are close and there are times for you to pick numbers that are a little bit further away. In general, when I'm redoing an SSG or when I'm looking at a brand new SSG, I like to stay somewhere around 20-25% below the current price. So again, let's examine some other choices. Perhaps if I lowered that estimated average low PE to 21, and that would give me a low price choice of 274.10, I would get a number that's in my comfort range. And indeed, I do get a number that's about 20% beneath the current trading value of 341.69. Now, the SSG also offers me other choices. I'm going to reject choice B. That's too low in my estimation. $230.80 is just too far away from the 341.69 for it to have any bearing on helping me come up with a realistic, reasonable stock selection guide. Might I choose the recent market price low of 270.10? Absolutely. I think that's a wonderful price that might vie with the price that comes from my lowering the PE to 21. That's a great price that I might use because I have rationale to support it. It's close enough to the current price to be meaningful, and it actually occurred at about the same time that a lot of the index values reach their peak values and then have come back down again. So that 220 low price of 270.10, I'm pretty happy with. The 52-week low, I just think it's too close to the current value, as is the 221 low price. I'm also going to reject the price the dividend will support because I don't think Domino's Pizza pays a large enough dividend for this metric to be valid. I think the dividend has to be at least 3.5, or even 4% before I can use this metric as a possibility in coming up with the low price. So what did I finally do? Well, I stuck with the choice A and I stuck with the PE at 21, the average low PE at 21. And what happened was that I ended up with something that I'm completely happy with. I ended up still in the buy zone. I ended up with an upside downside that I feel is extremely reasonable. And choosing that price A is what I do 95% of the time after taking careful thought to come up with an average low PE that tries to fit what's happening in the real world. I'm very pleased with that choice for Domino's. I think that that low price of 274.10 has a chance of holding no matter what the market might choose to do in the next 6 months or 12 months. Don't forget the forest by focusing on the individual trees, folks. There's never a single correct choice. My 21 fit my thinking, but your thinking might have brought you to 20 or 21 and a half Or you might have made the choice of the low price over the last 3 years. Your chosen judgment, yeah, your chosen judgments have to make sense to you, and you need to be able to support them with some rationale. It's just not enough, especially in a bear market, to say I'm being conservative and pick a number that is completely unrealistic as far as the data being displayed in the SSG. Rather than make a mechanical choice for low price, think about the results of that choice and be very willing to adjust it when it's necessary. Thanks a lot, folks, for listening, and I'll send it back to you.
All right. Well, thank you very much, Ken. Lots and lots of good advice in that presentation. All right. So next, we are going to take a look at the visual analysis graph on the stock selection guide and see what maybe we can learn about the stock by reading between the lines. So really, when you think about that large graph on the stock selection guide, it's really giving us a picture of the historical income statements over the last 10 years. A simplified version, yes, but nonetheless, that's what it represents. So on the left side of this slide, you see a very simplified form of an income statement. Uh, and if we take a look at that, we see that we start with sales. That's our green. That matches our green line over on the stock selection guide. We take off expenses, and that leaves us with our pre-tax profit, which is our pink line on the visual analysis. We take off taxes. That leaves us with our net profit. Divide that number by the number of shares outstanding to leave us with our earnings per share, our blue line represented on the SSG. But if you think about what's between those lines? Well, what's between sales and pre-tax profit? Well, those are our expenses. That space represents the expenses that the company has. And what is between the pre-tax profit and the earnings per share? Well, there's a couple items there. There are taxes and there are the number of shares. So there's a couple of things that will affect the number of the earnings per share. Let's look at some examples here. So here we see our pink pre-tax profit line is rising a little bit faster than the sales line. So you can see that if you kind of scrutinize it. I've added some arrows to make it easier for us. So we can see that that's rising faster. And if we think about what's between those lines, we think to ourselves, well, that's the expenses going down. That space represents expenses. So as the space narrows, those expenses are being reduced. What does that mean? That means our pre-tax profit margin is going up. And that's usually a very good thing. Here's a different situation. We have pretty steady sales, but our pre-tax profit and our earnings per share are falling off. Well, that means our expenses, that space in between sales and pre-tax profit, is getting larger. Our expenses are rising as a percentage of sales. And what does that mean? Well, that's a big warning sign that our pre-tax profit margin is indeed dropping. So you might want to look into that. You know, sometimes you're going to see, as you're scrutinizing these various graphs, some spike. It's not a gradual, like we just looked at in the previous couple slides. It's not a gradual change, but you're going to see a big spike. And when you see a big spike or a dip in the pre-tax profit as you're comparing it to sales, That's very, very often due to some kind of a one-time gain, if it's a spike, or a one-time charge if it is on the dip side. I've put a couple of examples here. It could be that the company sold a part of their business and took a gain from that, and that would be recorded on the income statement, and you would see that as that little pop up in the pre-tax profit. If you saw a bigger dip, it might be that the company was exposed to some kind of big fine, a litigation expense. Those are two examples. There are a lot more that you can find, but usually when you find these big spikes or big dips, this is a one-time issue, but you don't know that until you do that last point, and that's to investigate further. Here's an example. We've got pretty steady sales, but pre-tax profit is all over the place, pretty erratic. Yeah, I'm not too interested in something like that. Why? Because to me, it looks like management doesn't seem to have their costs under control. Again, reading between those lines, I'm seeing one year the expenses are down, they're narrow, and then they fall way off, and then they come back up again. Management's all over the place, and that's not the pattern that I want to see. So now let's look at the space between the pre-tax profit and the earnings per share. So our pink and our blue lines. So here we see that the earnings per share is rising a bit faster than the pre-tax profit. I think you can see that. I added a couple arrows, but the reasoning, remember what's between those, is that there's either the company is buying back shares of stock and or the taxes have come down, or there's been a change in the tax rates. It could be a combination of the two. It could be one or the other. But when you see this, as we're seeing right here, when earnings per share is consistently growing faster than pre-tax profit, that's often a sign that the company is steadily repurchasing shares. Okay. Now we can get a little bit more information if we add a line to the graph. And that line is the orange line that you see that I've added there. So our net profit that comes after we take our pre-tax profit, take off our taxes, that leaves us with net profit. If we add that gold line, that orange line, whatever it is, to our graph, the net profit line, well, then that's going to clearly tell us whether the change is due to a change in taxes or number of shares outstanding, because we have now differentiated the space between pre-tax profit and net profit. We have taxes. Between net profit and earnings per share, we've got the number of shares outstanding. So in this case, I see that, in the first part of this graph, maybe the first 6 years or so, the tax rate was really pretty steady. That's pretty even. But then there was a narrowing of the tax expense, I guess I would call it. And that implies that the tax rate went down. And yes, about 4 years ago, we did make a change in our tax code for corporations, and they started paying a lesser amount of taxes per the tax regulations. And also you can see that maybe there's something going on there with the number of shares, but it's really kind of hard to discern on this particular graph. So before we get to that, I am going to just remind everybody, in case you are not aware of how to add a line to the graph, it's right in the legend, and I'm using an SSG Plus. This is available in the SSG Plus tool. So you can click on various line items and add them to the graph. So I've selected net profit here, and that then makes that orange line appear. Now, when you see an unusual spike or dip in the net profit, similar to what we saw with the pre-tax profit, you could probably think that that is very, very often due to a one-time tax benefit or expense, Because remember, what's between the pink pre-tax profit and our net profit? Taxes. So when there was that big dip in this particular case, that means that they had a larger tax expense due to that tax code change. The 2017 Tax Cut and Jobs Act is what it's called. And many companies had to take a larger expense. So that is a pattern that you might see. Again, taxes and number of shares outstanding. Now, one more thing, and I said it before, sometimes it's hard to discern if, the number of shares are changing that much. I do have one more hint. Oh yeah, I already said that. Taxes increased significantly. I have one more hint for you, and this isn't really reading between the lines, but this is a bonus tip that you can actually see the shares outstanding plotted right on the graph by selecting that from the legend. So I've done that here on this particular chart that we were just looking at. So I've added that lighter blue line at the top, shares outstanding. And yeah, there's a little bit of coming down on that, but it's not changing significantly. The number of shares has really been fairly steady. And so therefore, it really hasn't had a huge effect on the earnings per share. So much of the change that you see between the pink and the blue line is all due to those taxes. So I just want to leave you with this screen because this, to remind you, is the model we seek. We are looking for those companies that are up, that are straight and parallel. We like to see our pre-tax profit growing at about the same rate as sales and our earnings per share growing at about the same rate as pre-tax profit. This is what we are looking for. And I hope my talk tonight helped you understand a little bit about why we are looking for those up, straight, and parallel companies. So with that, Ken, I will ask, are there any questions I can address, or should we just move right on to 5 in 5?
I think we're ready to move right into 5 in 5, Ann.
All right, super. Thank you for watching those questions. Yeah, so we will take us to 5 in 5 right now. And this is where we offer you a few stock ideas for you to think about, research, and consider. And a reminder that these are educational items. We aren't making any recommendation. And you must do your own research before doing any investments. We aren't seriously recommending these to go out and buy right now. All right, so with that, let me bring over, I'll make this just a tiny bit bigger. I know that helps people's eyes. And Ionnie, I believe this is your first stock, and maybe you can lead us off with this one.
Yep. Hey, thanks, Ann. So this first company is CWT, California Water Service, and it's a small utility sector company within the industry of regulated water. It operates regulated public utilities in California, New Mexico, Washington, and Hawaii. I chose this stock because so far in the TickerTalk list for 2020, we don't have any utility stocks. So I use the screener tool to find one of the best utility companies. I like this company so far from my brief research on it because even though it's in utilities, they have a good handle on expenses. Management is doing a good job. If you scroll down, Ann, you'll see that management has been able to increase its pre-tax profit on sales as well as decrease its debt to capital ratio. And as you can see for sales and earnings per share, they've been able to grow it at about 4 to 7% respectively. We can go to the back side of the SSG. So with this being a growing utilities company, I've also noticed that their stock price has been the range of the stock price has been increasing from 2017 to 2021. But with that being said, they've also been able to increase earnings per share, and their PE ratios seem pretty reasonable and staying in that 25 to 35 range. They've been also increasing their dividend, which all looks good to me.
All right. Great idea. If anybody's looking for a utility, that looks like an interesting one. Ken, first up for you is?
About Visa and V.
Yep.
What I'm doing right now is preparing a long list of stocks that I'd like to own or I'd like to add to. I've been a holder of Visa for many, many years. I hold it in a couple of the clubs that I belong to. I also hold it personally. I find it to be an outstanding company. And up until recently, I don't think it's been a stock that has particularly piqued my interest as far as being able to buy it is concerned. I'm suggesting that the current turmoil in the market might have made this stock something that's very interesting to look at. Look at the sales estimates from Morningstar. Those are ACE estimates, 2-year sales growth of 19, earnings growth of 17 and a half. That's a 5-year call. This is a very large company, and for a very large company to grow at those kind of rates is exceptional. If we look at the bottom, I'm seeing that Visa makes a lot of pre-tax profit, and that pre-tax profit seems to be pretty stable for the last 5 years or so. Return on equity is just superb. There's a little bit more debt than we might look for, but I will tell you, if you were to go and check the debt coverage, you would find that Visa is having no problems at all dealing with the servicing of the debt that they carry. Let's turn it over real quickly, Ann. This is a blue chip company, and it's very fairly valued right now, down from where it might have been in the last couple of years when the PEs moved into the mid 40s. Right now, we have a current PE of 32.1 and a 5-year average of 32.9. I think it's a very interesting stock, and I would urge you never to study a stock in isolation. So if you're going to study Visa, there are some other really high quality stocks in the same particular industry. I would urge you to put MasterCard on the list, maybe American Express, and maybe a couple of others, and study them as a group.
Okay. Good looking stock there, Ken. I might have to look at that one. I haven't looked at Visa in a while. But great minds do think alike, Ken, I will say, because you started out saying why you picked Visa. I'm picking Costco wholesale tonight. And my whole reason is because I've been watching this market and I do not own Costco and I would love to own Costco. I think this is a superb stock. Look at those lines. I mean, I could hover over, you can see what they do. I think most people are familiar with Costco. The leading warehouse club retailer. Uh, they have limited number of things that they sell, and they sell all kinds, sell them very well. They make a lot of their money, most of their money, frankly, on their membership fees, and everything else is kind of at cost, you might assume. But anyway, most of the profit is from membership fees. I just I like this company. I shop at this company, and it always seems like it's too expensive. And so I've been kind of eagerly watching it go down. I mean, if you own it, maybe you're not so happy about that, but I know where I might like to buy it in for my SSG. But the steadiness of this is just outstanding. You can see the consensus estimates there are really in line with their historical growth. Their profit margins, while slim because of what they do, they do sell a lot of groceries and they do sell a lot of things at just a low markup to their members. But those are very nice and consistent margins. Their return on equity is in the excellent area. And they do have, a tad bit more debt, but I'm really happy with seeing that the level is pretty steady over the last 5 years. I know this is red indicating debt is up, a teeny tiny bit, I guess. But I'm not too disturbed by that. Taking a look quickly at the valuation side here, uh, I see that it's still a little high priced. For me, you do your own research. I'm not ready to pull the trigger at this point in time. I do know they announced earnings today, and I thought they would do well. And you know what? They did do well, I thought. So I think this is a company that will get through any recession fairly well. That's another reason that I'm kind of looking at Costco. But it's still a little bit expensive as compared to its average. It does pay a modest dividend. I am putting this on my watch list and doing my research and coming up with the place where I think I would pull the trigger. It's not quite there yet for me, but I encourage you to do the same if this is something that you would like in your portfolio. All right, I'm going to come back to you, Ionnie, and bring up your second stock.
Okay, thanks, Ann. So this second stock is TPL, Texas Pacific Land, and again, bringing to the community an industry, a sector in the industry that isn't talked about too much, energy, and the industry is oil and gas exploration and production. That's what the EMP stands for. So they're based out of West Texas. They own a lot of land. And the great thing about this company is that they're basically making money off of the land. They have very little overhead, and they're being paid in royalties. They have two segments of their business: land and resource management, and then water services. So, as you can see here, this small company has been growing phenomenally, over 30%, both in sales and earnings per share. And in the section of evaluate management, despite the red that you see for pre-tax profit, just take a look at the actual numbers. This is how you know that this company has very little overhead. They've been able to have anywhere between 80 and 90% of a pre-tax profit on sales. So every dollar they're bringing in, they're keeping 80 to 90 cents on that dollar. So this is very high profit margins. Their debt to capital is a little low, and you can see that their return on equity has been decreasing. That's, one red I would be a little bit more concerned about. But overall, looks like a well-run, high profitable company. We could switch to the backside. And I'm going to make this quick note too. Over the past, I want to say 5 to 7 years, there have been multiple first cuts done on TPL. I think Bob Huell himself did 2 of them in a span of 7 to 10 years. So, if you want more input on TPL, feel free to check out the first cut because that can really help add to your analysis. But back to section 3 of TPL, we can see that their high and low prices have been growing steadily. Their earnings per share has been growing tremendously. Yes, there definitely are some dips, which comes with that sector, but overall, their dividend payout is pretty fairly high. Even though their current PE ratio is a little on the higher side, I would definitely keep this on my watch list because if I look at the column E, the low PE ratio, this company has a history of dropping down in the low 20s of a PE. And so that's kind of where I would be looking to pick up TPL when the time is right. Thanks, Dan.
All right. Thank you, Ionnie. One last pick from Ken.
This is Zoetis. I'm in a lot of investment clubs, and in my clubs, we have doctors, medical doctors, and we have doctors that are doctors of veterinary medicine. I will tell you that the doctors of veterinary medicine, their practices are every bit as profitable, maybe more profitable than the practices of the human medical doctors. People will do or seem to be able to do almost anything for their pets in the time that we're living in right now. Zoetis is a general provider of materials and supplies to the veterinary hospitals throughout the country. You can see the consistent sales growth, which has shown a little bit more of an upward tick from maybe 2016 on. You can see the nice consistent earnings growth, except for that one dip in 2015. And I'm looking down at the management comparisons. I'm seeing really nice profit margins from this company. I'm seeing exceptional return on equity, and the debt to capital is high. Let's face it. Again, I would go to other data and I would look for interest coverage. I will tell you that again, Zoetis is well positioned to service all of the debt that it carries. It doesn't seem to have any problem carrying this amount of debt, and it's been doing that high debt level, it looks like, for at least the last 9 years. Let's turn it over real quickly. This is not a cheap stock. This is richly valued. People understand the bonds that humans and pets have. They understand what people are willing to pay for their pets when they get sick or when they have issues. And because of that, the PE values are rich. Right now, Zoetis is even valued higher than its 5-year average. I think it's an interesting stock for you to take a look at, but I just want to put that big flashing neon sign out there that this is a richly valued stock, extremely interesting to study, and it does have some competitors that you can put it up against and study them as a group.
All right. All right. Thank you both for your good ideas. This is a quick review, folks, in case you missed any of those tickers. These are the 5 that we talked about. And that wraps us up. We do not have a scheduled date yet, but watch that Better Investing weekly email. That is where we will be announcing our next Ticker Talk. I will tell you that we are likely taking June off because many people are very busy with the Better Investing National Convention. We'll be in the 3rd week of June. But we'll be along sometime in the summer. So watch that Better Investing weekly email, and you will stay apprised of all of our events that are coming up. And with that, these are our email addresses that you may shoot us an email if you have a further question or a comment. I want to thank Ionnie for joining us. First time, not the last time, Ionnie. Super job. Thank you so much for joining us. Have you
Thanks,
back
Ann.
soon. And Ken, as always, a joy to work with you. Thank you, sir.
And Ann, I want to remark that we're at the 59-minute mark, and we haven't done that in a long time.
Hey, I wasn't even going to mention it, but
I
since
think that was
you
good luck.
I think Ionnie did bring us very good luck. So with that, let's end, and we'll be ending on time. So that's it. Thanks all, and good night.
Good night.